When it comes to financial literacy in the United States, it is something that we are severely lacking. When we think of the methodology and really instruction manuals to everything we do, there is a systematic approach to do a majority of things. And of course, the FOO, if you're unfamiliar with it, it is the financial order of operations. It is really a blueprint of what to follow. And that's what we're going to be covering in today's live stream. Now, this is from the Money Guys. This is something I know they introduced years ago, and a lot of people don't know about it, even when we were kind of bringing it up at work, which I am in the financial sector. We wanted to talk about it and understand the operation of things. Now, if you're familiar with Dave Ramsey, his baby steps, overall, some of the baby steps don't fit into and really applicable to a lot of people that I do financial counseling with. And even when I read them myself, there's a point where I kind of question the logic behind them and how they're going to work and how they do work in a real life situation. Now, nearly 60% of Americans cannot come up with $1,000 or do not have $8,000 from an unexpected. If they have an unexpected expense, they have no way to come up with the money. This means that people are going right back to credit cards. Now, I know a lot of people don't like the basics, the fundamentals, thinking of budgeting, managing your credit card debt, saving for retirement. This is where the FOO, or the financial order of operations, really does come in. So again, this is from the Money Guys, and I want to cover this, and I want to share kind of my insight as I've been doing financial counseling for about 15 years now, and I have a ton of people that I work with on a free basis. It's completely free, but I do love doing it. So first, what are the ground rules? And this is what they share for the philosophy. Generosity is not a single step in the FOO. It is a ground rule where, of course, if you cannot give money, you can always donate time. Now, for my wife and I, even looking through work, we do a lot and we donate a lot of time because we have the talent, we have the time. Knowledge is power. Unutilized knowledge, unfortunately, doesn't really do anything. But if you don't have the money, you can always do your part and really be generous outside of giving money itself. The goal to invest, and ground rule number 2, is 25% of your gross income. If you think about that, that's going way above and beyond Dave Ramsey's 15%. When you get to the point, 25% of your gross income will set you up for an absolute perfect retirement. There is no question when you start looking at and breaking it down. And getting to this, of course, is not very easy, but it will take time and you can get that. Number 3, which is my favorite when it comes to ground rules, debt is a 4-letter word that you should not be familiar with and you should not want at all. When you think of debt, it is literally giving away your hard-earned money every single week in the form of debt, in the form of interest that you're paying for things that you have. In addition, with that debt and what you're paying in interest, you're giving away time. That is something you cannot get back. If I have to work a day, if I have to work 5 days, if I have to work 2 weeks to pay the interest on the things that I have, I am giving away my time for the debt that I am carrying, which of course can be really counterintuitive to future you. Now, ground rule number 5, liking what you do makes it easier. For me personally, doing YouTube, I absolutely love it. Doing the financial education piece, it is another thing that I am super passionate about. When I see the impact that I have on individuals, not only doing the channels here, where comments are, you really helped me with a couple things. I understand this. I'm investing in this. What do you think? Giving my advice is something I will always do. And that is the reason why doing the financial channel here on YouTube, absolutely love it. And number 5, you only get one life. That is another really, really big ground rule that people need to realize. Your time is valuable and your time has money. Like I was saying earlier, when it comes to Dave Ramsey, when it comes to the baby steps, this is actually a 9-step breakdown with the FOO, which makes sense. And when we break it down, you'll see how it does seem to logically make a lot more sense than what we've seen in the past. So the first step in this is deductibles covered. Now, again, when you think of the financial order of operations, you are looking to cover your deductibles. You're not looking to cover all your deductibles. You are just looking to cover the largest one. So the deductibles could be your insurance deductible, which is a big one, your healthcare deductible, which is another big one. Without covering those insurance deductibles and not being able to cover that expense, very similar to what we see with an emergency fund, but we'll talk about that later, means that if something happened, if there's a disaster, if there's something with your health, if there's something with your car, if there's something that is an emergency, if you cannot cover that deductible, you're going to be out that money and you're going to be, unfortunately, unable to pay that. Now, of course, there are a lot of other things when it comes to deductibles, HSAs. There's a lot of different tools in there that we can talk about that we'll get into. But when you start looking at covering your deductible, you want to cover step number one, your highest deductible. So for me personally, high deductible healthcare plan, we have, I think, a $2,000 deductible. So instead of, again, thinking of in respect to the baby steps, this one is having $2,000 covering your insurance deductible. If your insurance deductible is much lower, you're going to have a much lower kind of coverage or deductible once you have that covered. So once we get that done, so your deductibles are covered in the very first step of this FOO, we get into step two, which is the employer match. This is, again, a point where this makes logical sense to me. It really makes a big difference when you're going in here and when you're doing the FOO versus doing those baby steps, because the employer match. So what I see, and again, really speaking from experience, is a lot of people will, one, want to build up that emergency fund. Two, they want to eliminate debt. 3 years down the road, 5 years down the road, 10 years down the road, they want to build an emergency fund. They want to go ahead and manage debt. They want to eliminate debt. 5, 10 years have passed. They are not putting anything in retirement. We are literally sitting still at zero. No 401k contributions, no IRA contributions. There is nothing because they never got really past step 1 and 2 to the point of eliminating debt. They accumulated more debt, had an emergency, took on some more debt, got some personal loans, got a mortgage, got another car, got in some more debt. The never-ending cycle that I'm seeing right now through financial counseling doesn't allow, if you're only focused on debt, to eliminate the debt and then get on really with other steps in your life and being able to invest. Now, when you start thinking of the employer match, this, again, is going to be one of your absolute priorities, because when you think of the employer match, if an employer is giving you 5%, you're putting in 5%, guess what? You're getting 100% return on your money, guaranteed, because they're giving it to you upfront. Then if you see growth within that investment plan, you're getting well over that 100% return, because that is huge. Now, if they don't have an employer match, that's okay. You're going to have another step to really do in here. But of course, you want to make sure that you're getting, at the very minimum, whatever they are offering you. Now, when you start thinking of your employment, and again, we're going to use that 5%, when you start thinking of your employer, that is part of your compensation package. When you think of what they're offering, not only like healthcare, which a lot of people get, you get dental, you get vision, you might get insurance, you also get the employer match. That is a benefit. That is part of the benefit package that you have. This gives you the ability, and really, you want to go ahead and match this employer, and seeing what some employers do. Employers can match up to 25%, which is incredible, but they can match up to 25% of your employer contributions, or your employer contributions in the employer match, which is kind of crazy. Traditionally, we see about 4 to 5% is what we normally do. Me personally, again, going back to myself, we do, and my employer offers a 7% match. So even looking at the chart from the Money Guys, when you look at a 7% match, it really cuts about 4 weeks of pay that I am getting back if I'm sacrificing and not putting it in there. Years of pay gained in retirement is about 9 weeks of pay based on a 7% match. So when you think, again, the compounding aspect, when you think about the contributions and the growing in there, it's going to make a big difference over the long term. Now, is the employer match guaranteed? There's a couple things, and you have to know your plan. When it comes to the employer match, some companies offer it, some do not. And of course, if you don't do it, you're leaving money on the table. But you also have to know that a majority of employers have a vesting period. So what we mean by the vesting period is they'll say, we will match your employer contributions, your employee contributions, up to the, let's say, that 5% again. But if you leave your job within a certain amount of time, some of those are 2 years. Even looking at a bank that I was working for, it was 3 years to be vested, meaning that if you leave within the first 3 years of employment, you lose all of the employer match in its entirety. They take all their money back. So you have to know exactly what the vesting period is for where you work. Some places don't have a vesting period. A majority of them do. When it comes to the vesting period, you want to make sure that you are getting that match, and getting that match fully. Now, the FOO step number 3, high interest debt. This is the point where we eliminate that debt. This is where we do get it. Now, when we think of high interest debt, or a lot of people coin it as the bad debt, meaning that it is going to have a high interest rate. When you start looking at a mortgage, when you start looking at auto loans, most of them are falling right now about the 6 to maybe 8% range, possibly less depending on when you purchase. When you purchase the vehicle, meaning you're going to have a lot lower interest rate than you are focused on with those credit cards. When you think big picture, credit cards are the absolute biggest detrimental, really pitfall that we see when it comes to lending because the interest rates are so high. I have seen credit cards going up to 36% interest. Guys, if you're running, $5,000, $10,000 on a card that's charging 30+% interest, it is getting and really burning a hole in your pocket and taking away, again, your time because you're paying all of that money in interest. So does a mortgage count? No, a mortgage is excluded when it comes to high interest debt. Even again, looking at a lot of mortgages, we see them at 2.5%, 3.5%, 4.5%. That does not count. It is a low interest debt, which is going to be different. Now, 0% credit cards. Now, this technically is a low interest debt, but there is a caveat when it comes to the 0%, when it comes to balance transfer cards, is they have the ability to not only skyrocket the APR, but a lot of them, if you don't pay a 0% off within a certain amount, it is kind of a teaser rate. They can have a much higher APR, or we've even seen some, Best Buy did this. I know Art Vanna did this, a couple of them where if it is not paid within a set period of time, they charge you all of the interest from day one. Even if you're carrying any debt that's temporarily at that 0%, it's a very, very dangerous game to play. And a lot of people that I see personally for financial counseling get burned on the 0%. So which one do you pay off first? For me, this goes right back to the debt avalanche. I do not believe in the debt snowball. I do the mathematical side, which I know the money guys do. Very based in numbers, very based in math, is if I have a card that's at, 15% and I have a card that's at 0%, depending on the balances with the snowball method, you're going to go for the balances first. Me personally, again, being a really big math guy, breaking out a plan, coming down with the fundamentals, I go and I tack that absolute highest interest rate that we have first. That is the one that you're going to get more bang for your buck. If I'm paying off, $1 and getting 15%, or I'm paying that same dollar and getting 30% because the interest rate on that second card is much higher, absolutely you want to knock that out. Now, once we get done with the debt, so at this point, our debt is eliminated, it is completely paid off, we get to step number 4, which starts our emergency fund. So this is very easy to get and very easy to build an emergency fund. When you think of a fully funded emergency fund, we are talking 3 to 6 months. Now, I know 3 to 6 months is a pretty big span for a lot of us. That could be $15,000 at 3 months to $30,000 at 6 months. There's a couple things that are kind of included with this emergency fund that you have to take into your own account. Now, when it comes to a lot of finance and when it comes to a lot of planning, it's going to be personalized to you. And that's something that I absolutely love to do. The personalization to you is, are you a single income or do you have dual income? Is it you and your spouse, your significant other, your wife, whoever it may be? Are there more than one incomes in the household? That's going to make a big difference on if you're saving 3 months or if you're doing 6 months. Also looking at your job. What exact kind of job do you have? It's a very sales orientated job that can have a lot of ebbs and flows, kind of some ups and downs with the sales depending on the economy. You might want to lean a lot more towards that 6 month versus leaning to the 3 month. Now, if you have a job that is in high demand, that's in a stable field, 3 to 4 months should be acceptable. And if you do have those dual incomes, definitely being able to do the 3 to 4 months. If you're starting to get passive income, if you got CDs, if you got investments, if you got a lot of other things, 3 to 4 months is good until you have, and really one of those other factors. So what should it include? It should include all of your monthly expenses. We're just not saying, oh, well, I want to cover my mortgage and my car payment. What else do you have? When you start thinking of the budget, and I know a lot of people don't like budgets, they don't like to talk about budgets, the spending plan, whatever you want to call it, as long as you have an estimation of what you spend on a monthly basis. Let's say, just running a quick scenario, that I spend $5,000 a month. Okay, $5,000 a month is going to be, and I might not have it down to every penny, exactly where I'm spending it, what all the bills are, but I know 1, all of my fixed expenses, 2, kind of ballparking what my variable expenses are going to be. Those, of course, can change from month to month, but a majority of the fixed expenses is going to cover probably 40 to 50% of my income right there. And then, of course, when it comes to the other parts of this, you really want to make sure in that emergency fund that you're funding the 3 to 6 months, depending on your specific scenario. And how do you know when you've completed it? It is when you can look at the emergency fund. It's 3 to 6 months. It is fully funded. Now, this money that is in the emergency fund, high yield savings accounts, this is money you're going to keep liquid. I have links down below for M1 Finance. That is a perfect place to put that emergency fund right now. They're paying 4.5%, so pretty good return, even a lot higher of a return than we see at CDs right now for a savings account. So literally parking your money there as an emergency fund in that savings account, earning 4.5%. If you're sitting again on 15, 20,000 in an emergency fund, you have to have it growing. You can't have it at the 0.46 that we see with traditional savings accounts in brick and mortar financial institutions. It has to be earning money on your money. And who doesn't want the emergency fund to grow? Seems kind of crazy to think. Number 5, we get of the FOO step number 5, Roth IRAs and HSAs. Now, when it comes to, we're going to start with HSAs. If you're eligible for an HSA, it is one of the absolute biggest things that people overlook. Health savings accounts have the ability and have a triple tax advantage. That's right. You have a triple tax advantage, one of the only accounts that carry it. So if you are eligible and have that high deductible healthcare plan, putting money into an HSA, not only do you get a tax break when you make contributions, you also get a tax break when it grows in an investment account. You also do not pay taxes when you make purchases for qualifying medical expenses with an HSA. This can include copay. For me personally, I have a high deductible healthcare plan. We have an HSA that we max out every single year. We get a big tax advantage from that, but also I have children, we have doctors, we have dentists, we have a lot of appointments that fall under medical that I can utilize my HSA card for. Now, in addition, the Roth IRA, this is another one. When we start looking at a Roth IRA, now you're going above and beyond the employer contributions that we're getting with that 401k into a Roth IRA. The money in a Roth is after tax, meaning that when you get your paycheck, you get your gross amount, and then of course your net or your take-home pay. The money that is going into your Roth IRA is coming out of that bottom line figure. It is coming out of the net pay or the take-home pay that you are getting to make contributions. Now, the caveat to this is you're paying taxes today for the growth that you're going to see in the future, because in the future, when you start taking money out of a Roth IRA, you don't have to pay taxes again. It is not double dipping in there. You only have to pay taxes once on the Roth with the money that is earned, contributions going in there. And that is the reason why they limit it. The government limits what you can put into an IRA, just like what they limit what you can put into a 401k. They don't want you saving too much money in there because, of course, like I said, in the future, when you start growing this account, making your contributions every year, going 30, 40 years, starting to see a really big snowball with the compounding interest in these IRA accounts. Now, one thing to note with the IRA accounts, if you make too much money, you can do a backdoor strategy. But the big thing with the IRA accounts, and I plead with you, please, it has to be invested in the market. I see a lot of people that have those IRA accounts. The money in the IRA account sits at a financial institution earning a 0.4, which means even though it's growing at that 0.4, which is an absolute horrible rate, you're not seeing the growth that you need for the IRA account. It has to be invested into something. It has to be invested into the market. Even if you're rolling it into CDs and a couple other things, inflation is going to eat up a majority of the funds that are in the IRA. If you keep it at your banks and your credit unions, if it is not invested in the market, the IRA accounts are not going to grow how you want them to with the retirement accounts. Because when it comes to 401ks, they are invested in the market. You have to do the exact same methodology when it comes to a Roth IRA and putting it into the market. Now, again, going back to the HSAs, once you know these are maxed out, you'll be really doing really well when you think of even getting 5 steps in here. So thinking, and just kind of a quick recap, number 1, you have all of your deductibles paid. Number 2, you are getting your matching contributions, which is very, very important because that's free money you don't want to leave on the table. Number 3, step 3, you've eliminated that high interest debt. 4, you've built that emergency fund, which is great. You're fully funding a Roth IRA and an HSA if you're eligible for one, which brings us up to number 6, maxing out your employer plans. Now, this goes above and beyond what we're seeing for the employer contributions. Now, like I said earlier, my employer matches 7%. So do I only put in 7%? No, of course not. I'm a finance guy. I've always been ever since, God, probably I was 10 or 12. Always loved finance, but maxing out the employer plans, I contribute 15% into my 401k. My employer matches 7%. So I am putting an exorbitant amount of money into my 401k. Like we said earlier, when we started this live stream, the goal was 25%. We are looking to get and put 25% of our income away, which is exactly where we are. I'm probably a little bit north of 25%. And the reason is debt. When I think of me personally, we have a home, we have a beautiful home that we're paying for. That is it. We do not carry any debt. We do not have credit card debt. We have no personal debt. We have no student loan debt. We have no auto loan debt. No debt at all makes a really big difference and gives you the ability to save a lot of money. So how much money can you put into these? Again, the government caps the amount that you can save in retirement accounts, which is kind of crazy. But when you look at this right now, it is $23,000 under the age of 50 that you can put in there. Now, this does not include the contributions the employer matches. $23,000 is what you can individually put there. So if I'm an individual making $100,000 a year and I'm putting my $23,000 or 23% of that into the max in here to get that actual contribution, I can cap out the money that I'm putting in my 401k. And then, of course, I do get the match on top of that, which doesn't include. Now, of course, there is a caveat to this as well. And again, this is going to be very, very imperative on your situation. There's a lot of 401k plans out there that offer horrible investments. They are not worth putting money in. They are not investing in there. Does it make sense to max out an employer's 401k plan if the investment vehicle they have is not good, if it's very horrible, if it's a very bad investment plan? Absolutely not. I would keep it at that point, putting whatever I get my match in. So again, if we get that 5%, match your 5%, the rest of this, I would put into an individual brokerage account or an account outside of my my employer if the investments are really bad, if they're not something that you're seeing growth in, if you're not seeing returns in. Now, number 7 of the FOO is step number 7 is the hyper accumulation. This is something we've actually covered in a couple videos, and I'm super excited again to see this. When you start looking and investing north of that 15%, we're talking 20, we're talking 25%, we are talking 30% of your income going into investment accounts. This is the point where that snowball is starting to really roll, where you're starting to see a very, very fast accumulation of wealth, and it will compound back. It's incredible how fast the compounding starts when you're putting a lot of money into the investment accounts. And just thinking about paying down everything, if you're putting a lot of money on credit cards, you start seeing those balances go down. It does the exact same thing when you're putting money into these investment accounts. So we're going to get up to this 25% of your income that is going into these investment accounts. And of course, this makes a really big difference, but lies a question, which a couple things, again, reverting back to those baby steps. What about retirement before paying for your child's education? Why is it important? So what I see, again, going back to my financial education and my financial counseling experience, a lot of parents, a lot of grandparents sacrifice their retirement for their kids. Guys, you have to worry about yourself first. There is going to be a point where your kids have a career, have a job, are getting raises, are saving money, are repaying those student loans. Do not sacrifice your retirement. Do not sacrifice your personal well-being to take care of your kids in your college education. Even though if they do have to do student loans, whatever it may be, you really want to make sure you take care of yourself first. It is something, again, that I see a lot where, hey, I see an individual take out a home equity line on their home. They borrowed $150,000 to pay for their kid's education. Their kid, guess what? Congratulations, is an engineer making $150,000 a year. The parents are still paying on that home equity for the next 15 years with zero help from the kids because, of course, they fully funded the education. they're not giving them 150K back. The kid is scot-free. The parents are stuck with 15 years of debt. Now they're going into retirement. They have a home equity they can't afford because they paid for the child's education. If you can pay for a kid's education, great. If you can save money, if you can put it aside, absolutely phenomenal. If you can help them anytime that they're in college, great. But don't sacrifice your retirement, your retirement itself. Do not sacrifice it. It is crazy to see that, again, people are sacrificing their well-being because of their kids' education. Now, when we talk about brokerage accounts, this was another one. So once you get over that 25%, maxing out your contributions to your employer, then we look at the taxable brokerage accounts. Now, this, of course, is a good thing. So we have our savings account, we have an emergency fund. When it comes to traditional brokerage accounts or taxable brokerage accounts, there is no limit. If you put $10,000, $100,000, $1 million into a taxable brokerage account, there is no limit. This is going to be the place where hyper accumulation is going to happen. This is the place where if you can put more than 25% of your income away, great. That is going to make a really, really big difference. And when we get to this point, there's only 2 steps left of this, with step number 8, prepaying future expenses. This is something that covers like kids' education, where you have all your money, you're saving in the 401k, you have the IRAs, you have the HSAs, you're putting away 25% of your income. Above and beyond that, this is the point where child's education start going to coming into play. 529 plans. Me personally, I have the MESP program through the Michigan Education Savings Program. This is a 529 plan, which of course they changed this last year. So the 529 plan, I am the custodian for my kid. When I'm putting money in there, doing contributions, it's growing with my contributions. They give me a tax rebate or tax refund based on the money that I'm putting in there. Then if the money grows, and when the money grows, which it has over a number of years, if that money is used for education purposes, they do not pay taxes on it, which is awesome that they don't pay taxes on there. Now, of course, if you look at this, it could also come into a custodial Roth IRA if the money is not used. So let's say, for instance, my kids go to a school and they go on a full scholarship. Everything is paid for. Don't need to worry about anything. Everything is paid for. That 529 plan all of a sudden becomes a Roth IRA as a savings plan. And I believe, you might not quote me on this one, but I believe it is up to $35,000 that you can convert into that Roth IRA. So really, really cool thing that they added to really incentivize people to save for kids' colleges. And we know it is getting a lot more expensive. So then the question is, should you save for your kids' colleges? Absolutely, if you can. Like I said earlier, I don't want you to sacrifice your retirement. I don't want you to put other things on hold or put things on the line just to try to cover the expenses that they can cover through student loans themselves. As much as I don't like student loans and I don't like student loan lending, it comes to a point where you definitely have to. And the final one we have here of the FOO, step number 9, prepaying or paying off low interest debt. This is going to be the elimination of those car payments. This is going to be the mortgage. This is going to be where right back here, it is the debt-free journey. It is the point where you finally reached truly independent. That means you have no debt at all. You're getting rid of everything. Again, when you think of the ability to take control of your income and keep all of your income, guys, if you have no mortgage, imagine that for me personally would save me about $1,000 a month. That's a payment that I wouldn't have to make. If you paid off those $400, $600, $800 car payments, that's a couple $100 every single month that you're not shelling out with interest. You're getting your money back. You're getting your time back, giving the ability to amplify the investment strategy that you have. Putting more money away, of course, is going to create more income through the passive income. And it goes, it just, again, kind of really starts snowballing. And it's so cool right now because at the age of 45, I am going through this exact same thing. In the next 5 years, we're paying off the house, meaning we have zero debt. We owe nobody nothing. We have everything completely paid off. That is going to give me the ability to catapult retirement, putting away literally thousands of dollars a month that we have an income, which is going to be awesome. So does it work for everybody? It does, to a point with the FO or the financial order of operations. it is going to be tailored specifically depending on where you are. If you're saving money, you're going to be in different parts of your life. And honestly, when you start looking and knowing what exactly the financial order of operations, the way, then the methodology that you need to be putting this together, it does make a really big difference. Now, does it work for everyone? Will it work for everyone if you're retired, if you're young, if you're middle class, if you're in the middle of your career? Doesn't make a difference. It's very similar, like we talked earlier about the baby steps. Does it work for anyone? Yes, it will. It's not super complicated. It is literally a blueprint that is going to be tailored to your specific, really specific scenario. If you're a single individual, if you're working, if you're dual income, if you're like us and have 4 jobs, which is kind of insane. But when you start looking at this and having the ability, there's going to be points in your life where you're at different points in your life. But when it gets to the point of eliminating debt, that is number one. And when it comes to debt, and I can't really end the live stream without saying it, when it comes to debt and when it comes to budgeting, when it comes to financial planning, when it comes to really anything financial wise, it is up to you to take accountability of your money and accountability really to yourself. When it comes to finances, the more time and effort you put into it, the more time and effort and rewarding you can get out of it. If I know that if I spend $50 on something that might not be an asset, might not create value for me, might be something that is a short-term fix that I need to look at, that means that $50 I cannot spend anywhere else. If I can save a little bit of money, if I can scrimp, if I can cut, if I don't have to get Starbucks 5 days a week, if I can cut it to 2, taking my extra $15, putting $15 every week into an investment account, that is giving me $60 on a monthly basis that I'm putting in an investment account, that I'm repaying debt, that I'm not utilizing. You have to understand money is not infinite. Money is always has a purpose. For every dollar you spend, that is a dollar that you cannot use anywhere else. You can't save it. You can't, use it to repay debt. You can't put it into an investment account. The more you take control of your finances, the more you educate yourself and really understand, makes a really big difference. It does change, again, a little bit of a operational change from the baby steps. But when I go through Dave Ramsey, when I read the 7 baby steps, yes, do they work for a lot of people? It's almost somewhat of a realignment of priorities. And I know the baby steps are kind of an older system, and it does work very, very kind of on fire, getting rid of debt, focusing on that. But like I said before, from my personal appeal, I didn't like some parts of the baby step because I've seen people 10 years down the road that are never doing the employer match that have literally gotten nowhere when it comes to the debt repayment because, of course, they're not budgeting properly. They're not having their spending plan. They don't know exactly where their money is going, which is a game changer for the rest of your life. So guys, I hope it was very educational for the video. If you like the content that we're putting out, and we're putting out videos on this channel on a daily basis, please subscribe to the channel. Let me know in the comments below what you guys think. And as always, thank you guys for watching.